Awesome. All right. That was really good. Thank you, Claude. There's yeah, these little books are really good. I know John Bogle has one too, The Common Sense of Investing as well. And uh,
Yes.
Jack Schwager just shared that and the value investing. And I know uh, the Joe Goldblatt, the magic formula. And that's really interesting, which we can maybe talk about his strategy and the Greenbelt on Saturday. Maybe I'll do a little segment on that. So um, I want to make a couple of comments, and I think uh, Friedman is a very intelligent. He's a very well respected analyst, and he's very intellectual. He's won, I
Mhm.
think, quite few awards, especially when it comes to financial statement analysis. And um, so I wonder, as far as his portfolio management, if he's done anything with real money or not. I'm not sure, but a couple of the I think observations I made. I always love to have like screens, learn about things. Uh, Number one, I share your basically as far as the shortcoming of the analysis. You mentioned the 10-year that he chose. It was a very trending 10-year. A lot of growth stocks did well. I'm glad you chose the utility, one of them, and we had Southwest Airlines. But it was, the US growth market was number one. So I would have loved to see something happening in the whole cycle starting like 2000. And
Mhm.
it would have been good to see in different cycles what would we be. And that's one thing I noticed. The second part is looking at those criteria that you introduced, which is wonderful, we've written down. But as an average investor, retail investor, it some of those are very difficult to have access to, right? So it is really, you have to become real analyst and do your own due diligence, go find things. A lot of these informations come like Bloomberg Terminal, and that's a little difficult to find for, again, average
Mhm.
person unless you subscribe. And I want to share, if you don't mind, I'm going to share something because you just mentioned um, as far as let me just go to start talking about it. And you mentioned it. So sometimes the simple things are also helpful. And I'll just looking at one of my portfolios. So, can you see? I mean, what I see? Are you? Everyone
No,
can. No.
I don't see. Hold
Oh,
on,
okay. Can you
maybe.
stop sharing? Maybe that's what it
Oh,
is.
I see. Oh, yeah, yeah, there you go. Yeah, I see it. Sorry.
Okay. So one of the things that you mentioned correctly, and that was, I think you were surprised, and that's the one that I really like, and just the simplicity. I call them the insider and the high short ratio. So
Mhm.
I love the insider buyings and then high shorts. And so I want to share with you, this is the screen I did, and it was October 17th. And basically, these are the companies that came out. There were five of them. And believe it or not, one of them was Carvana and did
Mhm.
nothing. And then now you can see, I mean, that portfolio is up 76%, all five of them. Of course, Carvana is just, it's a beat,
Yeah.
was up already 40%. But something like the simplicity, that really helps for like someone who wants to do just but I really like that, again, he's very analytical, and I like that the way he went through the whole thing. But I just mentioned, I wish it would be a little more simpler to
I think
understand it.
I think Ramin Carvana, like I think there are two things there because Carvana has had some debt problems as well. I think they're coming out of the debt problems
Correct.
underneath their debt problems, and I think that's also another reason. So you have high shorts, and I think their debt situation is improving. Um, and
Yeah.
then so maybe I guess I think that was one of the criteria he mentioned. Like improving debt
Yeah, no,
situation.
I mean, that's
So
a really good one. And I totally agree with the analysts, and we've talked about it with the earnings that can be manipulated, accounting gimmicks and all that. And I really like the free cash flow. We've talked about that, and then enterprise value. And but I just want to say, I mean, this thing did not happen. So I was watching, it's like for a month or so, it was in the red. And then you've got to be patient. And I think the same thing with the criteria. You just have to be patient, and then things start moving. But anyway, I'm gonna stop sharing that. But I just
I
thought
think
that's
and he does say that you're like what he's trying to do is limit the pool so that you can fish in a smaller pool for potential winners, and then so your probability is higher, but it doesn't, because I mean, this is like high risk situation. He does say, to manage your risk appropriately. So it's very speculative what you're doing here, because a lot of these, I think even Bed Bath and Beyond, you had activist investors come in,
yes.
and they were not able to save the company. Company still went bankrupt. So it's not always where activist investors come in and
Save the
save the
day.
day.
Yeah. Another the other thing that really surprised me, well, in a sense, we always look at the investment grade. We, of course, being a bond investor, you always want quality, and then here we are. And of course, it gives you more potential. So you have the volatility. Higher volatility gives you a lot more potential. Debt structuring, and then change of the story, and of course, be looking at the bond rating. So there's a lot of these are kind of a stocks that they've had some negative news built in them. So like again, Carvana was going bankrupt. I mean, it was like really
Yes.
down in the dump. So obviously now, I think year to date they're like up 1,000% or something. So things like that happen. And but as an analyst, when you look at Carvana, I don't know anyone would have given it a buy rating on that, because all the elements were not there. But very interesting. Yeah, again, Friedman is a very analytical, very smart guy. He's written a few other books on financial statements. He's a bond guy, so he's I've seen him 2 or 3 times actually, and but this is very good. So I like to open the floor for anyone who likes to have any questions. Again, I appreciate Jean-Claude. That's really good, and I hope he can do this once a month from different sides, and everyone can basically participate. Any comments? Anyone else has anything?
Yeah, Jean-Claude, I just wanted to add you sort of mentioned it towards the end of your presentation. The whole timing of it, is it sort of like review the data at the end of December and pick your top 5 candidates for the whole year?
Yeah, that's what he did, right? And I don't think it's necessary. I think you can do it anytime when you find these situations. But he picked, for every year, who was the top winner, and then he tried to figure out the previous year what markers were there that would help you pick that top winner.
So for instance, theoretically, you could say, okay, I want to do it for September. I'll look at the data, start September 1, and then maybe set like a threshold goal that you want to make 20%. And when you make 20%, you get out, or you take 50% off and then keep the other rolling, something like that.
These things are there. He's looking for big returns, like 100 plus, in a year, doubling your money in 1 year. And so that's the strategy. So, and then he said, like, even if you don't pick the big winner, but if you pick 5 stocks that could be winners, they, even some of them will still go up by a lot if they hit. That's why he said it's good for groups where you come up with a group at the end of the year, try to select as a group 5, 6, everybody picks a stock, and then you'll have who will be the winner the following
it
year.
sounds a great strategy. You have 5 stocks and 4 do nothing and 1 goes up 100%. And that's still a nice win. That's 5 stocks going up 20% each. So it's the math on it's good.
Yeah. So we could do this. We could say, okay, we all of us will each of us selects the stock, and then we invest, in that pool. Like if there are like 10 of us, there'll be 10 stocks, and then we'll see how that portfolio does by the end of next year.
I like that idea. I would do that. I'm in.
And we weight Ramin's the most.
Yeah, we let Ramin pick them. I love that idea. I like that idea even more, Jean-Claude. Ramin, was your slide, was it active investors, high short interest, or inside interest? This,
No, so it's-
oh, sorry.
You're asking me, Martin? Or?
yeah, was it high short interest and insider buying? Was that
Yes. It's
Okay.
insider buying. That's basically, I think, like, remember we had a class on insider buying. So what are the best ones? So this one I noticed even Carvana, there was a large buying came, and we like to have cluster buyers, but when they have a high short interest and insider buying, I found it pretty successful. But of course, in this situation, it was kind of did not apply. But again, I think it was more of a timing of things. One of the things also, remember, 2022 was a negative year. So it was a lot easier to find these kind of, candidates, at least for me. Obviously, I put more weight on insider buying when everybody's negative. But also October was kind of a bottoming time. You recall it was before the midterm elections and all that. So it was a good time to have that. So there's a lot of things in my favor, but still, it completely outweighed whatever the market had done since then. But yeah, so it's a very simple insider buying and a high short interest, usually over 20 or 25%.
You know what? Logically, it sort of sounds, it makes sense, because you have the people who don't know thinking the company's going to go down, and the people who are on the inside who would know think the company's going to go up. So it's sort of like,
yeah, I mean, that's the logic for it, right? And also, you want to make sure it's not manipulated. Like Bed Bath and Beyond was, I believe, that was manipulated. I mean, the CEO comes and buys all these, and then stock went like to $25 or 40, I don't know, whatever it happened. And then the things were, he was just part of it, but he had some other things, and they dumped it later. So, so those games also paid. So you got to be careful, but it's a simple one. As far as like those five, I think, Jean-Claude, like the CFA Society had, you come and pick 10 stocks. And I think, Martin, you've been part of that. So every year, beginning of the year, I will pick the 10 stocks, and then you have to predict what the yield is going to be by end of November, because we had the dinner in December. So the winners come from, they have to calculate from 1st of January to November 30th. And then you have to predict what S&P is going to be, what NASDAQ is going to be. And the interesting thing was I was in charge of the calculations, and I think part of the board we had to do, because that was our job. And, there were years that I did really good. I was up, 49, 50%. But I never, I finished once first, but there were people in our group that they would be up like 170%. And I have obviously, because I calculated those, so I have a copy of their stock. So supposed to be, obviously it's a private thing, but there are some really good stock pickers. What we used to do, so that criteria was the stocks have to be $10 and over, and they cannot be ETFs. That was changed. It used to be we could have ETFs, but now it's only pure stocks. But imagine there are some people who are just good stock pickers, and every one of those winners, they came because of the high volatility, and they were all growth stock. Right? It's all about timing. Again, we are talking about 2010 and on. So it was good to find those. So I think it might be a little more challenging. But there's a lot of good criteria in this. The only thing was, making sure everything is, we can have access to the information. So it's not just simple. We cannot do this on Finviz, for instance. You have to have some.
Where, can you get information on activist investors coming in? Is it just reading the Wall Street Journal, or is there like Are there, is there a place that compiles it or?
So that's a good question. I don't know if we get, the SEC filing, we have the 13F and 13D and 13G and all the other ones, something will show up. I think when there's a big ones that uh, we used to, was it Zell, Mike Zell, and cons, and the ones that or Bill, that some of the big hedge fund managers were very actual activists. You get it from their sites maybe, but I don't know if there's any specific. I haven't seen, unless we go to a general like um, um, bar charts or something like that might be getting, or what's the other one that there's Ben's Bez, remember that, but unless do that. So I've never screened for that. Let's put it that way. And I don't know how, unless we are activists ourselves, to look for those, and
Yeah.
or just have to read the news when the news comes. And basically, on Thinkorswim on the side, you have that short little bar that it gives you all the news coming immediately. So if anything important, they show you. So I usually look for the high put ratio. If there's a big lump, put options are happening, they will show you unusual volume activity. But yeah, I haven't seen that, and I really haven't followed it closely too much. It's more of a passive rather than active, but obviously it works. So
What I found interesting, I mean, also you had these jumps when something happened, like 35% jump, but you would think, oh my God, it's over. It's too late to come in now, but it wasn't. It was just the beginning of the move.
that's right. That's good. There would be a little dip, and then there was another catalyst, and it would just push it higher. Yeah. So, and I think that's what the technical analysis also can become helpful on top of that. So just watching the charts. That's a good point. The okay. I'll come back to me. Anyone else has any comments? My brain is thinking. How did you find it? Anyone? Yes.
Yeah, thank you so much, Jean-Claude. It was great. The only question I have is we cannot use this one is like for like not swing trade, but for like a short-term trade, like a 3 months, 6 months. Is that possible or no?
You could once it moves, it moves. I mean, you don't have to wait till the end of the year. Like I think in one of the cases, I think it was AMD, it went all the way up and then came all the way back down, but it still made like 80% return, but it was at 200 at one point, so you can um get out early.
Yeah.
And should just like buy an option or no, just the stocks only?
I think you'll want to buy. I mean, some of these might not maybe. Well, they are S&P 500, so you should probably like a leap, right, Ramin? Because you're waiting all year, so you don't want time value of money to go against you. So you'll have to do leaps.
Yeah.
Right. So one thing you have to remember, though, and this is a good question, Matthew, because we can also use the power of options, in activities in the option market. Because a lot of times when there's, like you just mentioned about these, the activists come in, a lot of times you see a lot of options activity also. They also go the back route. They don't want to show that what they're doing, and so that will be helpful. The only concern I would have is you do really need these big moves, because these are volatile, like I said, 1.5 and over. Obviously, that means there's a high implied volatility. So you have to be aware that you're paying a high premium for these. And especially with leaps, there is going to be quite a bit of premium that you will pay. But obviously, you can use your capital. Depending on your capital, this is obviously much more favorable. So if you're doing beginning of the year, yes, then I would do a a leap, perhaps, obviously over a year, and then just use it as that. But other than that, I mean, his main criteria is obviously portfolios. If you have a large portfolio, use this as, buying a stock.
He did say like use 5, like take maybe because you can't, it's difficult to get the one winner. So
Right.
select maybe 5 or 10.
Yes, so that would be a portfolio, so you can diversify that. But
Is-
you also
is-
could do leaps. Yes, Henry.
So is that like his main risk management strategy is to just diversify and buy a basket of these? or-
Diversify and size, yeah.
Okay,
It's not his, I mean, he does other things. It's
Right.
just he's doing on the side for fun. He's like, if you want to get your speculative juices out, you can do that.
yeah, I was just wondering if he talks about like the risk management side of it in the book at all.
Other than that, other than just selecting a
Six.
few and sizing it appropriately. He does call it speculation because you don't know.
Yeah.
It's I was just concerned that it was just 10. Like he could, I don't know why. I mean, for a book like this, I would have thought that they can go back 30, 40 years. You know what I mean?
Yeah,
Like
I
they
mean,
just did 10 stocks.
have access to the information, it's not like, yeah, that was a concern. But again, he's very bright, and I think the whole book about this, because he's really has analytical mind. So his whole goal was to analyze rather than doing the portfolio management. I think that was the whole, like, to open a gate or the door for us to find the winners. And it's very similar, again, if you read the Joel Rembrandt, his magic formula, he has similar things. The other thing is, again, he's I think the first half of the book you read is he really poo-poos the analyst in a sense, this
Absolutely, yes.
traditional ideas that we all, most of the analysts, by the way, and I will, that was really good chart when you showed, 94% is buy and hold, only 6%. You have to remember, being an analyst is not just about analyzing the company. There's a lot of politics involved in this. And it's all about relationship with the management, for instance, with the company. So imagine I have this wonderful relationship with Apple, and I'm the first one who goes and puts a sell signal. I won't be invited to their next dinner party. So there's a lot of things, there's a lot of relationships. Remember, a lot of companies, actually, analysts pay the companies to analyze them. So there's a lot of these relationships to be on the good side. So that's the reason I think he has rightly so said it. I think these old traditional ways of analyzing companies is just really way past. And the last thing I will say, a lot of these analysts, and I think we've talked about it, it's a good old boys club, in a sense. They all go to this, most of the time, if you're in New York, they go to the same bar after hours, same restaurant, they talk to each other. So sometimes there's this herd mentality. And if you put a sell, it's a good story. You just mentioned that WorldComs of the world, or Enron's. Enron's one of the most beloved analysts stock. Everybody loved that. There was like 2 or 3 which were very adamant, and they came out a few years before that, and they gave the warning sign, but they were poo-pooed aside. And so they do have this like an old club mentality. So I really like this part, because I've talked to all of you. It's like, you want to be your own analyst if you want to, be successful. And there is these analysts, they get paid regardless, because the company is gonna keep them. And the last thing I'll say is, again, when you put the sell signal, even as a portfolio manager, you become cautious, you lose your job. And the 1990s, 1999, a lot of very successful, bright portfolio managers were fired because they were not producing, 35, 40% return. And then they became heroes in the 2000 and on, because they were right. But anyway, so yeah, very good. I mean, that's very good. It opens a lot of, thoughts. And I like that, again, the volatility. And it was really interesting to see that, this catalyst, it's all about catalyst. That still we have to do some work. So
Yes, we do.
lot of
Yeah.
digging. So maybe we'll assign, each one of us will have like a specific hat. We pick and choose and say, well, I will just do the companies who have the debt structuring, and activists come in, and one does all the volatility. And no, I'll go for it. Like maybe in November or so, we come up with like candidates, or
Yeah.
this year, and
Yeah.
that would be fun, because that's what we used to do. So anyway, good.
We can limit the pool, like we take the below investment grade out of the S&P 500.
Yeah.
We take the most volatile stocks,
Yeah.
smaller stocks. And
Yeah.
then from that pool, we can start selecting.
Yes. Oh, okay. Amen. Awesome. Any other questions? What do you think about this book of the month? I think that was awesome. It's completely different. So, okay.
Yeah, it was
In this
great.
tradition. Yeah. And Henry, you read a lot of books. I mean, you come from all angles. And it doesn't have to be necessarily just investment, pure analytical. It could be more of the psychological side of things. And
Mhm.
that will be a lot of different angles you can approach.
Well, I started reading that book, Black Swan.
Oh yeah, well
Hmm.
that
I just started, so I don't know.
yeah, Talib that's really interesting. So yeah, that would be. I mean, he's very much into probability, all that. So a lot of math background. Yeah, that would be a fun one. Kind of a must read for some of his finance students.
Okay.
Yeah. All right, great. All right, well, wonderful. Go ahead, Mark.
No, I just blow my nose, Ramin. Sorry.
Oh, sorry. Appreciate it. All right. Well, Jean-Claude, again, on behalf of everyone, thank you so much. This was fun. Good
Yeah,
to-
thanks,
Yeah,
John.
Ramin.
Excellent.
Oh, no problem. I'll send you the presentation, Ramin. You want me to do that?
Yeah, you could. I appreciate it. We can just put it on as a part of the PDF. So it's
Okay, I'll
already.
send it to you.
Oh,
Yeah.
I've been recording it, so we'll send it to people who missed this. So.
And then Jean-Claude, send me the 10 winners.
Yeah.
The one winner.
All right.
Nice guys. See you
And then-
Saturday.
Saturday, yes. Thank you so much, everyone. Appreciate it. Good to
All
see
right.
everyone.
Thank you,
Bye.
Jean-Claude.
Bye.
Appreciate it. Thank you, Ramita. Appreciate
Thank
it.
you, John. Congrats again.
Bye.
Bye.
Thank you. Appreciate it. Thank you.